If you're an employer offering benefits to your employees, health insurance, for example, setting up the payroll mechanism, the contributions as we call them, is as important of a decision as what plans or products you're going to offer to your employees. In order to do this, we have to understand that there are two different ways that health insurance rates are calculated. That's the premiums that we get from the insurance company. That's the numbers that are on the bill. And then there are three different methods for how employers will continue to or agree to finance those insurance premiums between them and the employees. So we'll discuss those now.
First, we'll discuss how rates are calculated by an insurance company. And as we said, there are two methods. The first is the composite method. This is what you'll generally encounter if you are a large employer. That's a definition by state departments of insurance. And this is tiered. And what tiering means is that we assign the rates based upon a family composition structure rather than anything to do with age. So the common methods here are, you can see there's four main methods that companies will use. I'm not going to go over them individually, but you can see them here. The important thing to know is that these composite rates still account for factors of age with most insurance companies. So when they put together these rates for your employees, they look at your employee composition, they look at the age composition of all the employees, and then they blend those risk factors associated with age into these composite tiers. So sometimes if you're a small business, to make payroll easier to manage, companies will go to the insurance company and say, hey, can you give us the rates in composite rating, which is fine, but you have to bear in mind that the insurance company will anticipate changes in population, and they do take a look at your population to kind of determine where the price is going to be. So sometimes those composite rates will have a little bit of padding in the pricing. Sometimes that's intentional, sometimes it's just the way that the actuarial science works out. But be cautious if you go and ask for composite rating, because you may be adding a little bit more cost to your rates, and there's a better way to handle that through just effective contribution design. The second way that rates are designed by an insurance company is rate buildup. That's where an insurance company takes a rate table that's defined by law, and that table has what are called factors, and they say, okay, well, this is the factor table, and I obviously am not showing all dimensions, but it goes from technically age 0 to age 65, so it's a 66 column or row document that lists a range of factors, and then we take a base rate based on age 21 and we multiply it across each of these factors, and we get this output. And again, the full table will be attached. You can download it and have that information if you want it. So the way that a rate buildup works is we take each member of the family and we go to this table, we find their corresponding rate, and then we just add it up. Now there's one little technicality in that if we're dealing with small children, that's children between the ages of 0 and 21, the insurance company will generally stop accruing costs up to the three oldest children. So we take the three oldest children under the age of 21. So if you've got 5 children, for example, we only have to pay for 3 of them, even though we can insure all 5 of them. So you get a little protection there. And then adult children, though, ages 21 through 26, or up to 26, I should say, as many of those as you have, you're going to pay a separate rate for. So that's how rate buildup works. Now, understanding that is important to get to the question of, well, how many contribution methods there are, because we're going to design contributions around the rates. So we'll get right into it. The first method is the most common and easiest to understand. It's percentage method. That's where the employer pays a percentage. So using this example right here, we might say that the employer agrees to pay 60%, and the employee would pay the difference. And so a math formula for that would be 1 minus the employer percent. So in this case, if an employer is paying 60%, the employee would pay 40%. And you can break that up into tiers as well, not family tiers, but you might say, a company might say for the employee we'll pay a certain percentage, and for their dependents we'll pay a different percentage. Or you might say for Plan 1 we'll pay a certain percentage, and for Plan 2 we'll pay a different percentage. There's different ways of complicating this or expanding it, but this is the general idea. The next method is defined contribution. Personally, this is my least favorite. I don't like recommending this strategy. I don't think it works in most cases. But this is where an employer says, you know what, I want a fixed budget. I want just to have a set amount that I want to pay for health insurance, and then the employees can pay the difference. So an employer might say, for example, that they're going to pay $500 for an employee. If the employee's cost, or if the cost of insurance for the employee was $825, the employer pays the $500, and then the employee pays the difference, which in this case would be $325. You say, well, what don't I like about that? Employers like it because it gives you a predictable budget. You can say, if I hire an employee, I know what my insurance cost is going to be. What I don't like about it is, as much as that's appealing, is it doesn't make a lot of market sense. And the market issue that an employer has to address is, how are you going to compete for labor? How are you going to hire the employees that you want to? Oftentimes your wishes for budget management don't agree with what it takes to hire people. So this method right here becomes very ineffective in managing the pricing variation that happens with rate buildup. And so if you apply it to a rate buildup method, you're going to find that for some employees, your fixed contribution or your defined contribution doesn't go far enough, or for others it goes too far, and then those employees find out the differences that they're paying, and that creates issues there. It really creates a recruiting problem, an employee management problem. So now you might say, well, why wouldn't it work for composite rating? And the answer is it does work there. If you wanted to use it in this case, that's fine. But the only thing I would suggest is if you're going to design your budget around that concept, that's one thing. If you're going to communicate rates to an employee, make sure you communicate to the employee their cost. Don't communicate to them either percentages in a composite rating. Don't look at the employee and say, we pay $800. Look at the employee and say, you pay $325. That's a better way to communicate the information. And then the third method is the opposite of defined contribution, and this is actually my favorite method. It's fixed withholding. And what fixed withholding says is that as an employer, you're going to withhold the same amount from each employee, and you may break that up into classes. So you might say that, for employee only, we withhold this amount. For families, we withhold that amount. But you're going to pick a fixed amount. You're going to withhold that, and then as the company, you're going to pay the difference. And the reason I like this is because at the end of the day, as an employer, you do have quite a bit of budgeting control, and one of the things you can take advantage of is the cost, is the factor of averaging. Even though there's all the pricing variation that comes from the rate buildup method, you're going to find averages. The employees that have lower premiums versus those that have higher premiums, you get to blend that together as an employer, and you can take advantage of the average between those different costs where the employees individually cannot. So fixed withholding is a way to create a sense of equitability, where every employee says, you know what, I pay the same amount as the next person, and as a company, you have the ability to budget. You've created a sense of equitability. People like it. It keeps things simple. It makes payroll real easy because you know how much to withhold from everybody. You don't have to do complex calculations. So anyways, that's the overview of contribution methods. 3 contribution methods, and then there are 2 rate methods, and we'll attach these files to the LinkedIn. So catch you in the next video.